The air inside the temporary Treasury office on the Rue Vivienne was thick, not just with the scent of cheap oil lamps and stale sweat, but with the palpable odor of ruined promises. It was the closing days of the Directory, 1799, and the ghost of the assignat haunted every transaction. Once the glorious pledge of revolutionary wealth, backed by the confiscated lands of the church, the paper currency had depreciated so savagely that it required wheelbarrows, not wallets, to conduct basic commerce. Citizens remembered the staggering drop from 100 livres in 1790 to less than 1 livre by 1796. The state's credit was dead, murdered by hyperinflation and continuous military expense, a catastrophe that made men like Jean-Frédéric Perregaux and Jacques Mallet Dupin, titans of Parisian and Genevan banking, wince at every mention of public debt. Perregaux, seated at a vast mahogany desk salvaged from a noble estate, ran a ledger-lined finger down a column marked "Outstanding Obligations." He was a practical man, a Swiss immigrant who had mastered the intricate dance of exchange rates long before the revolution devoured stability. He understood that wealth was meaningless without trust, and the revolutionary government offered none. The regional banking houses, the private lenders who had kept commerce sputtering along through the terror, were exhausted, their reserves depleted by forced loans and the endless instability of government regimes. They needed a stabilizing mechanism, a single central pillar of credit, or France would collapse into fiscal ruin regardless of its military victories abroad. The irony was bitter. France was conquering Europe with bayonets, yet internally it was being dismantled by worthless paper. The coup of 18 Brumaire in November 1799 brought not just a change of government, but a seismic shift in financial ideology. When General Bonaparte, the newly minted first consul, walked into the provisional government offices, he demanded accounts, not ideological platitudes. He viewed finance as a logistic necessity, a precursor to military maneuver. "Victory requires iron, bread, and gold," he reportedly told his newly appointed Minister of Finance, Gaudin. And gold, specifically a centralized mechanism to leverage the existing gold reserves of the private banks, was precisely what was missing. Bonaparte had no interest in repeating the mistakes of the monarchy, which had relied on unpredictable tax farms, nor the mistakes of the Revolution, which had relied on fiat currency run amok. He recognized that the high bankers, the haute banque, held the keys to restoring confidence. They had the capital, the networks, and crucially, the trust of the merchant class that the state utterly lacked. Thus, the genesis of the Banque de France in February 1800 was not an act of socialist nationalization, but a deeply practical, calculated private venture, heavily encouraged and subsidized by the state. It was structured as a joint stock company, capitalized initially at 30 million francs. Perregaux, along with figures like Mallet and Lecoutal, became founding members and leading subscribers. They contributed their fortunes, their actual gold and silver, in exchange for the privilege of managing the national debt, holding state funds, and most importantly, enjoying the monopoly on issuing reliable banknotes. These notes, unlike the discredited assignats, were strictly backed by specie and discounted legitimate commercial paper. For the first few years, the Banque de France operated largely as the bankers intended, a stabilizing influence focused on Paris, discounting commercial bills at a reliable rate and ensuring liquidity in the commercial markets. It was a private engine serving the public good, but under the constant demanding gaze of the first consul. Bonaparte watched its operations with the scrutiny of a general observing the deployment of a critical corps. He needed its stability, but he increasingly resented the independent authority of the financiers. This tension came to a head in the mid-1800s, as Bonaparte transitioned from first consul to Emperor Napoleon I in 1804. His campaigns intensified, and so did the state's demand for immediate funds. The private directors of the Banque de France, adhering to sound banking principles, the very principles that had restored stability, were cautious about overextending credit to a government perpetually at war. They viewed war loans as high risk and insisted on maintaining a robust specie reserve to guarantee the value of their notes. They often resisted the emperor's demands to discount state-issued paper that lacked sufficient collateral, prioritizing the bank's stability over the empire's immediate military needs. This dispute over discounting policy became intolerable to Napoleon. The private management's insistence on fiscal rectitude was seen not as prudence but defiance of the imperial will. Napoleon needed the bank to be less a partner in commerce and more an instrument of state policy, a deep, inexhaustible well for his military ventures. In 1806, driven by this necessity and the desire to assert absolute control, Napoleon nationalized the Banque de France. He did not seize the assets entirely, but fundamentally restructured its governance. The crucial change was the creation of a governor and 2 deputy governors appointed directly by the emperor, replacing the independent regents chosen by the shareholders. While the original founders like Perregaux and Mallet retained their shares and seats on the General Council, their power was diluted. The final authority now rested squarely with the imperial government. The Banque de France was cemented as a state instrument, its primary duty now redefined to facilitate the financial logistics of the empire. This ensured stability remained, but it also guaranteed that the cost of glory would be borne, first and foremost, by the central financial institution established ostensibly to protect French commercial interests. The foundation had been laid, ready for the introduction of a currency that would truly embody the centralized power of the new empire and facilitate the immense cost of its ambitions. The 1806 restructuring marked the end of the honeymoon between the Parisian bankers and the emperor, but it did not signify the end of their collaboration, merely a redefinition of their roles. They were now civil servants of capital, instruments of the imperial treasury. With the centralized structure of the Banque de France secure under the emperor's hand, the next critical step was to secure the underlying currency system itself. Stability, Napoleon knew, was not just about the source of credit, but the medium through which it flowed. The introduction of the Franc Germinal in 1803 stands as one of the most enduring financial legacies of the Napoleonic era, a system so robust it would survive, largely unchanged, until the First World War. It was the antithesis of the assignat chaos. The Franc Germinal established a fixed bimetallic standard. 4.5 grams of silver, or 0.3225 grams of gold, constituted 1 franc. This precision was revolutionary in a Europe still dealing with fragmented, often debased regional coinages. The key was convertibility and fixity. Every franc note issued by the Banque de France was guaranteed to be exchangeable for this precise quantity of precious metal. This hard standard immediately attracted capital. Merchants and investors, wary of revolutionary paper, flocked to the stability of the Germinal. By fixing the standard, Napoleon created a currency that was not only stable internally, preventing the kind of wild inflation that had crippled the 1790s, but also reliable externally. It facilitated trade, encouraged savings, and, most crucially for the emperor, provided an honest unit of account for taxation and military provisioning. The Franc Germinal became the bedrock upon which the colossal financial architecture of the empire was built. With the currency stabilized and the central bank nationalized, the machinery was ready to fund the relentless campaigns that defined the Napoleonic Wars. The cost of maintaining the Grande Armée, a force that at its peak exceeded 600,000 men marching across Europe, demanding supply lines stretching from Lisbon to Moscow, was astronomical. easily dwarfing the budgets of all preceding French regimes. The financing was primarily executed through the Haute Banque, the loose confederation of private banking houses in Paris, like those operated by the Rothschilds, Barings, and Hope and Company in their European branches, but domestically managed by families like the Hottingers and the specialized dealers in government securities. The principal mechanism for long-term financing was the issuance of rentes, perpetual or fixed-term government bonds. These loans, often floated through private placement or public subscription managed by the bankers, were essential. Hundreds of millions of francs were raised over the lifespan of the empire. The bankers, while under the political dominance of the emperor, were pragmatists. They understood the scale of the emperor's ambitions and the necessity of his success for their own commercial environment. A French victory usually meant stable internal governance, access to new markets, even if coerced, and predictable debt servicing, so long as the military machine continued to function. Funding the war was not a simple matter of writing a check. It involved a complex structure of short-term advances, discounting military supply bills, often at significant premiums, and organizing the transfer of funds across active war theaters. The state often lagged on its payments, leading to tense negotiations and reliance on the bankers to bridge the liquidity gaps. For example, during the massive preparations for the 1805 campaign that culminated at Austerlitz, the treasury was perpetually empty. Private bankers stepped in, providing immediate cash against future revenues, such as expected taxes or anticipated indemnities from conquered territories. This relationship, while often contentious, was symbiotic. Napoleon needed their capital and their administrative capacity. The bankers needed the political stability and the high profits generated by the high-risk, high-return business of war finance. The reliance on these private networks became even more pronounced as the wars dragged on, forcing the empire to seek funding mechanisms that transcended national borders. It was here, in the burgeoning international finance market, that figures like the Rothschilds began to exert a geopolitical influence previously unheard of. While their deepest involvement would blossom during the later, most desperate phase of the empire, their infrastructure was already being utilized in the early 1810s. The great powers of Europe were not just fighting on the fields of battle, they were competing fiercely in the halls of finance. However, a significant portion of Napoleon's financing derived not from voluntary loans, but from external sources, the spoils of war. Conquered territories, whether the Confederation of the Rhine, the Kingdom of Italy, or the Prussian lands, were systematically subjected to heavy indemnities and resource extractions. This wealth was rapidly monetized and channeled back to Paris, significantly defraying the domestic debt load and allowing the Franc Germinal standard to be maintained, despite the continual costs of mobilization. This constant inflow of external wealth created the illusion of domestic financial health, masking the immense strain placed upon the state's resources. The system was designed to make war pay for war, but this external financing required a vast, unified economic administration to manage the complexity of taxes, confiscations, and currency exchange across a sprawling, diverse empire. This challenge would force Napoleon to extend his financial system, not just his armies, across the continent, creating both efficiency and deep-seated resentment in equal measure. As the empire reached its zenith between 1805 and 1812, the financial system designed in Paris had to be deployed across a continent dominated by French power. The need for administrative consistency was paramount. To this end, Napoleon undertook an aggressive, though often incomplete, effort to impose the Franc Germinal standard and French legal structures across his satellite states. In the Kingdom of Italy, the Confederation of the Rhine, and the reorganized territories of Westphalia and Poland, French taxes, assessed in francs, were levied heavily. Confiscations of royal and ecclesiastical wealth were monetized using the Franc Germinal's fixed standard. This financial imposition served two goals: simplifying remittances back to the French treasury and fostering the perception of a unified European economic space dominated by Paris. However, this process was rarely seamless. Local currencies, often deeply entrenched through regional trade habits and long-standing trust, persisted in daily commerce, making the actual imposition of the franc more of an administrative decree than a grassroots adoption. The French system was effective mainly at the level of state transactions, military purchasing, and indemnity payments, which were precisely the transactions Napoleon cared about most. Crucially, accompanying the imposition of the franc was the implementation of the Napoleonic Code. While primarily a legal achievement, the code had profound financial ramifications. It standardized contract law, property rights, and commercial regulations across the empire. For bankers and merchants, this standardization reduced transaction costs and risk. A contract signed in Milan had predictable legal standing in Brussels or Amsterdam, facilitating interterritorial credit and investment. This administrative efficiency was the hidden weapon of the imperial economy, stabilizing the legal framework required for the movement of capital necessary to sustain the wars. However, the massive logistical complexity of the later wars, particularly the Peninsular War and the preparations for Russia, demanded financing that exceeded the capacity of even the nationalized Banque de France and the domestic Haute Banque. This created the perfect environment for the rise of truly international financiers, most notably the Rothschild family. From their base in Frankfurt, and with emerging branches in London, Paris, Vienna, and Naples, the Rothschilds created a bespoke network of couriers, faster and more reliable than any state system, that moved gold, intelligence, and credit across borders. The unique genius of the Rothschild network was its ability to operate across the boundaries of war. They often facilitated funding for Napoleon's enemies, notably handling subsidies from Britain to Austria and Prussia, while simultaneously managing bond issuance and financial logistics for France. They were financial arbitrageurs par excellence, profiting from the differential interest rates and exchange risks created by the conflict itself. For the governments involved, including Napoleon's, dealing with the Rothschilds was a necessary evil. Only these networks could efficiently move hundreds of thousands of pounds sterling across hostile territories, transforming British silver into reliable gold or negotiable instruments needed for immediate military purchases. The wars provided the ultimate high-risk, high-reward environment, and the international financiers were the indispensable middlemen. The end of the empire in 1815 left the European continent reeling, but surprisingly, the financial structure of France itself remained largely intact. When the Bourbon monarchy was restored under Louis XVIII, they did not revert to the chaotic financial methods of the past. The Banque de France, despite being created by and for the emperor, was retained. It was simply too effective, too stable, and too necessary. Indeed, the first major task assigned to the retained Banque de France was managing the massive reparations levied against France by the victorious Allied powers under the Second Treaty of Paris. The indemnity totaled 700 million francs, plus the cost of supporting the Allied occupation army, bringing the total financial obligation to over 1.1 billion francs. It was a crippling sum, yet the Banque de France, leveraging its robust Germinal-backed structure, facilitated the gradual payment of this debt, mostly through floating new rentes and organizing international exchanges. The system Napoleon had created for funding glory was now repurposed for managing defeat. This retention and successful utilization of the Banque de France and the Franc Germinal model by the Restoration regime cemented its legacy. It demonstrated that stability and centralized control, once achieved, were politically invaluable, transcending ideological differences between imperial rule and Bourbon restoration. This model, a strong, centrally controlled national bank managing state debt, issuing standardized specie-backed currency, and operating within a unified legal commercial code, became the blueprint for central banking reforms across 19th century Europe. Ultimately, the Napoleonic financial system was not the result of a grand pre-planned scheme, nor was it defined by private bankers dominating the state. It was a pragmatic system, forged by the demands of ceaseless military necessity. Napoleon required an engine of war logistics that was predictable, reliable, and capable of operating at immense scale. He seized the existing capital and expertise of the private bankers and forced them into the service of the state, ensuring that the central bank was a government instrument. The cost of glory was steep, borne by the annexed territories and guaranteed by the structural stability of the Franc Germinal, proving that even in an era defined by martial splendor, the most enduring structure was often the balance sheet.